Good morning, everyone, and welcome to this post-federal budget review by our chamber member partner, MNP. My name is Tom Pura, and I manage communications and public relations for the Grand Prairie District Chamber of Commerce. We acknowledge our being on Treaty 8 territory, ancestral and present-day home to many diverse First Nations, Métis, and Inuit people. We are grateful to work, live, and learn on the traditional territory of Duncan's First Nation, Horse Lake First Nation, and Sturgeon Lake Cree Nation, who are the original caretakers of this land. We acknowledge the history of this region and are thankful for the opportunity to walk together in friendship, where we will encourage and promote positive change for present and future generations. We appreciate you all joining us today. With the help of Tracy and Heather from MNP, we will try to determine how yesterday's federal budget announcement will impact you and your business. They will discuss specific details and answer questions to help you prepare for your future. And this falls in line with our chamber mission to facilitate and inspire world-class success of our business and community members. This session is being recorded to be shared with those unable to participate. You can use the chat box to ask questions or use the raise hand function if you're more comfortable voicing your question. Heather Hilhorst is a partner in MNP's Tax Services Group, serving the Grand Prairie and Peace River regions. Heather works with clients in various industries, including construction, oil and gas, and logging, delivering effective taxation, succession planning, and tax planning services tailored to their specific needs. And Tracy Leishman is a partner with MNP's Taxation Services team in Grand Prairie, specializing in Canadian taxation services. Tracy works with family-owned and managed businesses in a variety of industries, including agriculture, oilfield services, professionals, forestry services, and retail. Please welcome Heather Hilhorst and Tracy Leishman.
Thanks so much, Tom. And thank you to everybody for joining us here this morning. I think we have lots to digest, and like with any budget, there's some information, and there's also some things that we just don't know yet. So our job here today is to just kind of talk about things that we do know and at a high level, and if there's any things that we need to maybe do some planning for in the near future. So here's just some general background on MNP. Here locally, we have I think 18 partners in our Grand Prairie office, and we all live, work, and play here in our community. And so we're proud to be a member of our chamber and a member of our community. All right, so I think the first one is one of the ones that probably most people have heard about, and we're going to start on the business tax measures. So announced in yesterday's budget was an increase to the capital gains inclusion rate. And so what that means is it's going to increase effectively the tax rate on capital gains held inside of a company. And so right now, 50% of the gain is taxed and the other 50% is not. And as of June 25th, 2024, so we have a little bit of a window, that rate is going to go up to 2/3 of it being taxed, so 66.67%, and the rest of it not being taxed. So this is a pretty big jump overnight once we get to June 26th. And we'll run through some numbers here in a quick second. So there are transitional rules that are going to apply for corporation. And what that's going to do is that any gains incurred between January 1st and June 25th will be taxed at the 50% or 1/2 inclusion rate, and everything thereafter will be taxed at the 2/3 rate. So there will be some requirements for you to track and stream what's a pre-June 25th and a post-June 25th capital gain inside of your business. So if we want to look at the number quickly, I just threw together some quick math on what this means to our businesses. So right now, 50% of the capital gain is taxed. So on a gain of $1 million inside of your corporation, you're going to pay about $233,000 of tax today. If we take that and accelerate or fast forward to July 1st or June 26th, that's going to jump up to $311,000. So that's essentially an overnight increase of almost $78,000, or an effective rate of 7%. If we run the math, so capital gains are taxed effectively if we flow them all the way out to our personal pocket. The company gets a refund for a little bit of tax, and then we pay some tax personally, and that's how they perfectly get integrated. So as of today, if we flow a capital gain all the way out to your personal pocket, we're paying tax at 25.7%. Come June 25th, that rate goes up to 34.36%. Okay, so that's an effective rate of 8.59% increase on a capital gain in a company by the time it flows through to your pocket. Okay. So that's a pretty big jump. And another impact this has to our businesses is that a couple of years ago, there was the passive income or inactive income rules were introduced into companies. And so it allowed for a threshold of investment income that could be still taxed at, a threshold that we were allowed to have investment income into our business without it impacting our small business deduction. So if we have less than $50,000 of investment income inside of our business, our small business deduction isn't impacted because of that. So now with this new inclusion rate increase on every capital gain, there's more of the gain that's included in that threshold. So we are going to actually lose our small business deduction faster with any company that has some investment income in it as a result of this change. Okay, so I think that I'd be remiss not to say that there's probably some planning that you may want to look at or prior to June. We recommend talking to your professional advisors. I've already received emails from my bank as well, my investment advisors on this as well. So I think that there's going to be a little bit of more to come with respect to planning on this inclusion rate as well. So I think that was the biggest news out of the budget for corporations, and rightfully so. An 8.6% jump is notable. There was also we heard leading into the budget, there was tons of stuff coming out about housing and the building of new housing for multi-families. And so to coincide with this, there was an introduction of an accelerated capital cost allowance for rental projects. And so capital cost allowances is the rate that we can depreciate our property inside of the business. And so normally a building can be depreciated at a rate of 4%. So if it falls into these special rental projects, meaning we have, at least 4 private apartments or 10 individual suites, and it's being rented out long term. So, this specifically cuts out any of the Airbnb type stuff. It has to be at least 90% leased to long-term tenants. We fall into this. And so we can increase the rate at which our property is being depreciated from a 4% rate to 10% on any construction that begins on or after budget date. We will also be able to use the accelerated investment incentive, which means that we don't have to use what we call the half-year rule, which only allows us half the deduction in the first year. Notable here, I think, is that often we don't get to use the full extent of our deductions for rental properties because they're limited by the amount of income that we have from rentals. So, it's nice that we can depreciate this faster, but I'm not sure if we'll see the full extent of the deduction just due to the limitation that we have to have rental income to offset that deduction. There was also some immediate expensing announced for what they referred to as productivity enhancing assets. So essentially, we can immediately write off patents, data infrastructure stuff, computers, any of the computers, iPads, electronic data processing stuff. So that just can get written off under Class 50 or the respective classes there. Again, this is for anything that was acquired on or after budget day, as long as it's being put to use prior to 2027. So a hot topic, I think, in the news these days is carbon tax, and the budget didn't fail to mention it, I guess. So there is a new measure that was introduced, and this is for small businesses and Indigenous communities. It does not mention partnerships or proprietorships. I think that's a notable thing here. And it's going to return a portion of the fuel charge proceeds back to these businesses. Not a lot of clarity on how that's calculated. It's for businesses that have less than 500 employees. And it noted in the budget that as long as your tax return is filed by July 15th, 2024, you will be eligible to receive your rebate for 2023 and any preceding years that they're going to include. It seemed to allude to the fact that it would start calculating this rebate starting in 2019. And so the first year we should receive from 2019 up to 2023 is kind of how I read it. But again, very important to get that 2023 tax return filed on time, because it's going to use tax returns filed prior to July 15th, and the deadline's June 30th. So I think more to come here. We're not really sure how this is going to roll out, how it's going to get paid. It's supposed to be an automatic mechanism, but I guess the devil will be in the details when more information comes out on that one. There was a previously announced clean electricity ITC, or investment tax credit, and this came in budget 2023, so last year's budget. They did release some further details on it, I think very specific for clean energy projects. So if it impacts you, happy to talk further on that one. So there was some announcements with respect to EV, or electric vehicles, and the supply chain management. There's essentially 3 different tranches of the supply chain that they're trying to, I think, promote. And the segments are electric vehicle assembly, battery production, and cathode active material production. That's a mouthful. So there's a tax credit of 10% available to businesses in this area, and that's available for the first 10 years of the credit, and it's going to be reduced down to 5% from in 2023 and 2033 and 34. I'm sorry. So this is for property acquired. This goes back to January 1st. And last but not least, with respect to business measures, and I guess maybe not least, I don't think this is one that we would see very commonly, but there was a change to the definition of what qualifies as a mutual fund corporation. So it is going to remove any corporate groups from being a mutual fund corporation controlled by any corporate group or for the benefit of a corporate group. And that's going to apply for year ends beginning after 2024. So.
Right. Well, thanks, Heather. That was quite a bit. And we'll move now on to some personal tax measures. And there will be a few other things that will impact businesses as well as we go through here. So not only for companies did the capital gains inclusion rate increase, but it also increased for individuals and trusts. So again, the rate will go up from half to 2/3 on or after June 25th, 2024. And for trusts, it'll be treated a lot the same as for companies. Just any gains after that date will be taxed at 2/3. For individuals, though, they did come in and say, we're going to actually keep the 50% inclusion rate on any capital gains up to 250,000 each year. So if you have a gain that's less than 250,000, you'll still be taxed at the current inclusion rate of 50%. So again, you really will have to track and know what time of year this year your gains were triggered. And you'll also have to watch and see, again, I think there's quite a bit of planning that can be done here. If you're in a spot where your gains will be less than 250,000 on an annual basis, this change may not impact you. But again, with some properties and some capital gains, if you're looking at gains on buildings or things that, you're selling all of it, you're not just selling and triggering a gain on part of it. A sale before June 25th will be taxed at a much lower rate than after that date. And again, we would just advise at this point, don't rush out and sell everything. You really need to talk to your professional advisors and find out how does this impact your situation and what is the best course of action for your own particular spot here. And with this as well, some people do have capital losses that have been carried forward. Again, there'll be adjustments to make sure that they're treated on a properly applied rate on the carry forward. So again, just a bunch of math the accountants will have to do here. Employee stock options. So if you do again have employee stock options, a lot of people, it's kind of when do we exercise them, when do we sell them? Again, the changes in the inclusion rate will impact those. So we'd say, again, talk to your advisors, see, what will this impact to me? Should I actually be doing something before the end of June here to trigger some gains on those? I did do a bit of math as well on this, and I kind of stuck with the same $1 million sale just to make the math easier. But math will not be easy going forward here because I'm not a fan of fractions, and 2/3 always is fun. But until June 25th, if you have $1 million capital gain personally, you'll pay tax on that of $240,000, so 24%. After June 25th, though, we will have to again figure out what is the first 250,000 of gains. What is the tax on the remaining? Anything over and above 250. And so in this example, on the $1 million, we start off with 60,000 on the first 250, and then 239,976 on the remaining gain, for a total gain of 299,976. So basically an increase of $60,000 from kind of one day to the next. Again, we're kind of comparing 24 to 30%, but please note that if the gain is more than $1 million, that rate actually will go up it could go up to 32%. So really you're paying 24% on the first 250, 32% on any gains over and above the 250,000. So like I say, you will have to kind of look at your individual situation to see, will this impact you, or, maybe some planning will reduce any impacts. With this, they also increased the lifetime capital gains exemption. So the lifetime capital gains exemption, it applies to very specific situations. And for most business people, it's when they're selling the shares of their small business corporation. For anyone in the farming community out there, it also applies to qualified farm land and also shares of a qualified farm or fishing company. So again, very specific rules, but if you meet these rules, it does allow a large exemption on the capital gain. So the capital gain has actually gone up and has been indexed. This year it was just over $1 million, and they've proposed then effective June 25th that the exemption will be 1.25 million. And then they're going to leave it at that until the beginning of 2026, and then it'll be indexed again. So depending upon what inflation does, we'll see the rates, the exemption slowly increase over time. The government does track past capital gain exemption claims. So whenever we deal with anyone looking to claim their capital gains exemption, we always make sure we check with Revenue Canada to see what has been used in the past, what do we have available going forward. So you don't need to track that yourself, but it is always a good idea to know, what do you have left of the exemption, and can it be used? Along with capital gains exemption, though, we always have this other tax, the alternative minimum tax. And prior to 2024, the alternative minimum tax was really a tax that did get triggered for most of our taxpayers in this area when they did have a large capital gain to which they claimed the lifetime capital gains exemption. And this minimum tax would be a calculation done in the background to say, oh, what would happen if you were actually paying tax at least a 15% rate? Would you pay more? And then you usually would have to pay this tax, and this tax went into a pool in which it would reduce your taxes owing in the future. So as long as you had future taxes, you'd prepay the tax in the year of a sale, where you had a big gain, you'd get the tax back, hopefully all of it, because you had a 7-year window to get it back. It's a very complicated tax, so I'm hoping I have said enough of it that people know that it exists out there. They came up with a bunch of changes for 2024, and we still don't know the exact rules on this, but one of the changes, they decided to increase the rate from 15 to just over 20% on the minimum tax. And they also included a lot more gains that would be subject to minimum tax. So now, instead of just gains that were where people were claiming their exemption, it would apply to just about any capital gain that was over about 170,000 of taxable gains. With these changes, though, they also said that they would reduce what charitable donations could be claimed against the minimum tax calculation. And they started off with 30% or 50%. They've now increased that to 80%, which was a good win. I know the charities have been lobbying to try and get that changed. And they've also added a few more exemptions that they were not allowing as deductions against it. So some positive changes for that, but it will actually impact a lot more taxpayers now, the changes to minimum tax. We really don't know, though, how, now that they've increased the inclusion rate, what changes to minimum tax will really impact taxpayers. But I guess it is a good thing to keep in mind if you are looking at any planning between now and the end of June, and you're thinking your capital gain might just be at a 24% tax rate, you actually might be paying minimum tax on top of that. So nothing is easy anymore. That's all I know. And I'm quite happy that taxes are calculated on a computer program. I can't imagine going back to doing it by hand. With all of these changes too for capital gain rates increases, they brought in a new Canadian Entrepreneurs Incentive. So this doesn't decrease the capital gain to zero, but it does allow for the capital gains inclusion rate to be half of what the normal rate is if you sell qualifying property. And here we don't know all of the rules on this again, so we're not sure where it'll impact people in this region, but it does allow for up to $2 million of capital gains per individual to be taxed at half the normal inclusion rate. So that would be half of the 2/3 now, so 1/3. This is starting for January 1st, 2025. So again, won't happen until next year. And the limit is just going to start at 200,000 a year and gradually increase to hit the 2 million by 2034. So something to keep in mind if you're setting up a new business and looking at new structures. Is this something you want to make sure your business is set up to claim at some point? So again, don't know the exact rules, but they did say that it will not apply for any professional corporations and businesses in the finance, insurance, real estate, arts, recreation, food and accommodation, entertainment, consulting, or personal care services. So they've kind of carved out quite a few businesses that I'm not quite sure if they truly will be carved out when the exact rules come out, or just what they're trying to not include here. They did say they were trying to not include any businesses where the value of the business is based on the individual that is currently running the business. So that was kind of where they're getting at. But again, it will be a big tax savings for people that do fit these new rules. So from capital gains, again, as Heather mentioned, lots of stuff has come out on housing from the personal tax side to help people with their down payments and buying a house. They have increased withdrawals available out of the home buyers plan. So home buyers plan has been around for many, many years, and it did allow people in the past to draw up to 35,000. So if it was a couple, each could draw 35,000 to help with the down payment. So this came out of your RSPs, and then you had a repayment where you needed to, over 15 years, repay whatever you took out back into your RSP plan. So they've increased it now from 35 to 60,000, which will help quite a bit. And they also gave people kind of a 3-year grace period before you have to start repaying back into your home buyers plan. So you do have to watch, though, it is money that does need to be repaid. If you don't repay it, the income that you're required to pay back each year just becomes into income, and you can choose just to pay tax on it in the future. So it is, though, to purchase a qualifying home. And it is, so most people think, oh, first home. I've bought my first home many years ago. But if you do run into a situation where you haven't owned a home for 5 years, or if you own a home but you don't live in it and haven't lived in it for 5 years and your family doesn't live in it, you may qualify again. So it doesn't hurt if you are looking at buying another home and you do have some RSPs built up. Does this qualify for you in your situation now? And with that, I also mentioned, I think last year we brought up that there's a new first home savings account. So this came in last year, and the first home savings account allows you to put in up to $8,000 a year. So over 5 years, you can get up to 40,000, and 40,000 is the max right now that you can put into this account. But it is like an RSP where any contributions in become a deduction against your taxable income that year, or you can carry that forward and deduct it in a year you want to. But the big advantage of the first home savings plan is that you can, whatever money you pull out for a qualifying purchase, you actually don't have to repay back into the plan, and you don't have to pay tax on it. So basically you can put 40,000 in, get a deduction for that in the years you're putting into the plan. And then when you take the money out to make a qualifying home purchase, you don't have to pay tax on that money. So when you're looking at that, if you are saving for your first home, make sure you're talking to your investment people, your bank, about this first home savings account, and make sure you look at opening one up. There's also provisions to allow you to move RSP monies from your RSP account into this first home buyer's account or first home savings account without triggering any tax. So again, talk to your investment people about that, whoever holds your RSP and the first home savings, and make sure you're looking at putting money there. Oh, and then we've got a whole bunch of other little things. So they did add, again, the budgets always seem to have a whole bunch of stuff in there with some small tweaks to them. There was a deduction for tradespersons' travel expenses. They're looking at harmonizing that and again, going back to 2022. So this was to allow tradespeople to be more mobile. So if you're moving from one place to another, there's up to $4,000 you can deduct in eligible travel expenses. The Canadian Child Benefit, there's always, an issue here where they're having to get people to repay monies if a child passes away. So they've increased it from 1 month to 6 months, where you're eligible to still keep collecting your child benefits for that child. Disability supports deductions, they've expanded the list here. So if you do have a disabled child or you are disabled, make sure you're looking and seeing of what you're purchasing to help you get through the day. It probably is deductible as a medical expense, or the disability deductions amount. Volunteer firefighters, they've upped that from 3,000 to 6,000. The 6,000 really means about a $950 tax savings. So again, a good way to see it move. They probably should look at increasing that, because volunteer firefighters are very, very needed around everywhere now. And the other one, mineral exploration tax credit. I think this has been in every budget for probably 10 years now. They keep saying it's going away, and every year, oh, we'll extend it 1 more year. So that one is just a given, I guess, in every budget.
Excuse me.
And then Heather, were you going to speak to the employee ownership trusts for me, please?
Absolutely. So employee ownership trusts were introduced in budget 2023, and then there was some more updates that came in the fall economic statement. Just to back up a little bit, an employee ownership trust is a Canadian trust that's going to hold the shares of the business to help facilitate the transition or the succession of a business. They do allow for more flexibility in that succession planning, and really allows the employees to borrow from the business to finance a buyout. It sounds really good, but they are really restrictive, and that's where I've fallen down on getting to implement one of these at this point. It requires that all of the active employees of the business are part shareholders or are involved in this employee trust. And that's where we've seen some hesitation on these. So the fall economic statement proposed a $10 million exemption on the sale of shares. So a huge tax benefit and tax savings, I guess, if your gain is exempt to transition to one of these trusts. There are specific rules that have to be in place for it to be qualifying. If there's multiple owners or vendors, they have to share that $10 million exemption and file a joint election if they're doing so. One of the things that the budget did introduce is that if this is if this exemption is being utilized, the trust has to qualify for the next couple of years. And what that means is it has to have active assets being used in the business. And if there is a disqualifying event, meaning there's too many inactive assets for 2 years in a row, they will, if it's in the first 3 years, deny that that exemption to the vendor, now meaning that they're going to be taxable on that event that happened a couple of years ago. Or if it's after the first 3 years, they're actually going to make it's going to result in a taxable gain to the trust itself. They're also giving themselves more time to reassess these, meaning that they're going to add an extra 3 years to the regular 3-year reassessment period, just giving more time for scrutiny and to find things, I guess. Any of the gains that are exempted are also going to be included at 30% for the AMT purposes. So, to add on to Tracy's laundry list of changes to AMT, I think we'll throw that in that bucket as well. So I'm really excited for these trusts. I just want them to be a little bit more user-friendly is what I'm hoping one day.
Yes, I'd like to see who's been using them.
I would too. I really would. And it has to be a fairly widely held company as well, because I believe I read nobody can hold more than 10%. So you have to still have quite a number of employees involved. So I'm hopping to some international tax measures. Just a couple of quick highlights here. There was some consultation and information on creating a framework of reporting for crypto assets. And this falls in line with what the OECD is doing, I think, internationally and trying to just stay in line with that. So the intention is to introduce some new annual reporting requirements coming out in 2026. And it's going to require additional disclosure of, exchanges of crypto assets. I don't know all of the crypto things. There's fiat currencies that you have to report as well on those exchanges. But it's also going to require the disclosure of this crypto service providers themselves. They're going to have to disclose who their customers are to CRA. And so that would include names, addresses, date of births, the country of residence, and taxpayer ID. So in Canada, that's your social insurance number. So just trying to get on the same footing as other countries, I think, and create a solid footing of framework for all of the OECD countries, and then also provide some disclosure and bring some transparency to the crypto asset reporting as well. So moving on to withholding taxes, I think that this is a little bit of good news. So currently, anybody that's providing services in Canada, so anybody outside of Canada providing services into Canada, is subject to a 15% withholding tax on their payments, unless they have a waiver that has been obtained from the Canada Revenue Agency saying they don't have to withhold. And so budget's saying, this is just this cost, or this extra 15% is being passed on to Canadian users or purchasers of those services. So they are hoping to simplify this process by waiving the requirement to withhold if that service provider wouldn't have been required to pay the tax otherwise. So if they're a treaty country, if they live in a treaty country and they wouldn't be subject to the withholding tax, or if what they're supplying or providing would be exempt from the withholding tax as well. So the examples that were in the budget were international shipping or aircraft traffic. So I think a little bit of a simplification that we may see. It doesn't appear to be something that is It's a waiver. It doesn't look to be a permanent solution, but hopefully that can extend and become something that's permanent and simplify that process. So indirect tax, again, in line with our housing announcements, they've expanded the rental rebate on student residences that are currently being built. Currently, residences weren't falling under the GST rental rebate because they weren't considered to be long-term rentals because students didn't live in them for a full 12 months. So those rules are being tweaked to allow them access to these rental rebates. And it's going to apply to construction that began actually on or after September of 2023 and before 2031. And cigarettes and vaping got more expensive again yesterday. So the tobacco tax increased as of today. And that was an increase overnight of an extra $4 per carton. And up to, there was an inflationary increase on cigarettes as well, April 1st. So as of April 1st to today, I guess they've gone up $5.50 a carton. A vaping excise tax is to come into force as of July 1st, and that's going to be priced based on milliliters of vaping things. I'm apparently uneducated in that area as well. Crypto and vaping, I don't know. So some other tax measures, charities, there was a little bit of, I think, simplicity offered in the budget for charities. I think bringing us just into modern day, there was some simplification offered on donation receipts. Removing where the donation receipt was being issued, if the asset had to be appraised for the donation, removing the appraiser's information. I didn't realize the middle initial of the donor needed to be on the receipt, but that's gone now as well. And then also allowing for the delivery of electronic receipts and electronic storage, not having to keep that duplicate copy in paper, as long as they are made in a non-editable format. So I think a little bit of simplicity there, which is nice. I think they also said that now we're allowed to use the word void on a receipt as opposed to just the word canceled. So again, I didn't realize that we had to use the specific word canceled, but that's also allowed now too. There was also an extension to the period in which foreign charities can be granted status as a qualified donee. And so this expands their registration from 24 months to 36 months. And it appears to be in a little bit of an exchange. They give you a little bit more time, but now have to provide, the foreign charities now have to provide extra information to CRA with respect to their donors. So total of receipts issued, the amount of the gifts, and how the funds are being used. So moving on, there was some Indigenous tax measures that were also announced in the budget. I think more consultation to come on some of this stuff. Further to Tracy's comments on AMT, there was specific exemptions, proposed with respect to trusts for the benefit of Indigenous groups. There was an invitation to stakeholders to share their views on these exemptions before the end of June. So I think if that's something that relates to you, there's an opportunity to voice your opinion or on how you think they work. There was also some tax exemptions announced for class action settlements. And this falls out of the class action settlements that from First Nations Child and Family Services, Jordan's Principle and the Trout Class Action Agreement. So any of the payments received from one of those class action settlements are intended to be included, that's included in trust. They're going to be excluded income to the recipients. There was also some amendments proposed for the First Nations Goods and Services Tax Act, which runs beside the GST Act, essentially. So it's the GST for people that live on reserves or settled property. And this is going to allow the Indigenous governments to enact value-added sales taxes under their own laws. So the ability to enact fuel, alcohol, cannabis, tobacco, and vaping products, like sin taxes, essentially, and govern them under their act.
Right. I get the great topic of tax administration. And I'd say the tax changes, they take a bit to swallow and to see. Some of these changes here, though, they seem a little overreaching for what I guess the work that we've done, but I'm not sure if there is a bigger issue out there that we just don't see here that they're trying to combat. So they're introducing a notice of non-compliance. So a person that hasn't been compliant with a requirement or a notice. So if you haven't filed, they'll send you a notice to file. Or if you're one of the lucky ones chosen for an audit, they'll send you a request for information. And now if you don't comply and don't respond to these, they're going to propose to impose a penalty of $50 a day up to $25,000. They say these penalties can be vacated by CRA or by a court if they feel that they weren't just. But again, if you do get mail from the government, please make sure you're opening it, and please make sure you're asking for appropriate help if you don't understand what they're asking for. They do, a lot of times they give very short windows to get back to them on, but make sure you do respond within that period, either ask for more time or to send the information that is requested. Measures against tax evasion. So again, this is targeting money laundering, terrorism, terrorist financing, and sanction evasions. So again, this is legislation for both the Income Tax Act and the Excise Tax Act when CRA are carrying out criminal investigations. So again, warrants for information and different things, again, trying to fight tax evasion. So more measures to come on that. This one I'm not sure as well. If you own vacant land that is residentially zoned, they're looking at doing some consultations. Again, they'll launch that later in 2024. So if you are in the construction industry and you own land that is residentially zoned and it's vacant, they're looking at applying a new tax to that. So again, really not sure how this will apply, but it is a bit scary because quite often there is vacant land for reasons where it's just not feasible to build on yet, versus vacant land that someone is just holding and not ever planning to build on it. So we'll have to see what comes out of this. Avoidance of tax debts. So again, they already do have rules around this. So, but they are trying to, I guess, strengthen them against if you do owe tax debts and you're avoiding paying them. So if you are participating in something that will move a tax debt or move assets out of someone's hands that has a tax debt and not for fair market value, there's already rules in place to allow CRA to go after the person that has bought the property at less than fair value. But again, they're just trying to, I guess, strengthen those, and they will look into more series of transactions. So if you do owe tax debt or a company or different things, I would advise being very careful as to what you're doing if there are assets in those companies and you are not paying your full tax debt. So again, haven't run into very many of these, so not sure what they're after there. So previously announced measures. So at this point in time, there is a lot of stuff that the government has announced that they're going to work on doing, and we're still waiting and waiting for some more rules. So this was the kind of list of major ones. So again, strengthening the intergenerational business transfer framework. So we had some rules that came out in 2021 to allow parents to sell shares of companies to their children's company and enable them to use their capital gains exemption. They proposed some new changes that were taking effect January 1st of 2024. The rules are proposed. They haven't yet passed legislation. We discussed AMT, so hopefully they will get those rules going and pass those. With everything that we do, there is the set of Income Tax Act rules, and then there's also the general anti-avoidance rules. So if you follow all of the rules for the Income Tax Act, but you end up with a result that the government really didn't intend, they can come and tax you under the general anti-avoidance rule. There's proposed changes that were to take effect January 1st of 2024 that haven't passed yet. And some of those changes won't take effect until they are legislated. So we're still waiting to see what will happen with those. Clean technology incentives. One of my favorites, proposals relating to the underused housing tax. So I don't know if people recall, or a lot of people out there probably were busy with their accountants filing underused housing tax forms. The forms were supposed to be due April 30th of last year. They got extended until October 31st. And on October 31st, the government said, hey, wait, no, we don't want these anymore. We're going to propose some changes to them. There will be specific people that still have to file these, and there is still some non-residents that are required to file the underused housing tax forms, which again are due the end of April now this year. And they have proposed rules around them that haven't passed yet. So we're fingers crossed that they will be passed and that they truly aren't due for April 30th. Along with this, I will throw out there, they also requested tax returns for certain trusts, bear trusts that were due at the end of March, which really became April 2nd this year. And on, the day before Good Friday, the government came out and said, no, we don't want these either at this point in time. We will provide more information on them at a later date. And we were hoping something would be out in the budget, but nothing was out in the budget on the T3 Bear Trust filing requirements. And I will throw out there as well, anyone that did file a trust return this year and happened to maybe file it on April 1st or 2nd, or your accountant filed it on those days because they were just busy with all of these trust returns. The government forgot to change their clock to calculate late penalties, and apparently a lot of notices have been sent out with $100 penalties on what they say were late filed T3 returns. CPA Canada and a few people got in touch with CRA, and they are now going to reissue new notices of assessment to reverse the penalty as long as the returns were filed by April 2nd. So just watch if you got a $100 penalty. Don't get too excited with your accountant just yet. Wait, you should get some more mail, but don't wait too long. Please let them know that you did get this and watch for the reversal of the penalty. I got waylaid there. Employee ownership trusts we're still waiting for. Some cross-border tax measures, EIFEL, hybrid mismatch arrangements. So again, this is all trying to keep with matching taxations for people that are working cross-border, global minimum tax, and digital services tax. So they are still working on a lot of these tax measures. Hopefully they will get some of them through sooner than later. And that brings us about to the end here. So now that I went off there, I will throw out before my closing remarks, I read an article a few months ago that said, hug your accountant. So, please hug your accountant, or maybe just a nice thank you. It has been a bumpy ride here this last year of forms we needed to file that we didn't need to file, and a lot of learning and a lot of work and a lot of informing people about changes that we still are going to be informing people about. So, be nice to your accountant. They're working hard to file personal taxes. And again, a reminder, they are due April 30th for most people. Some businesses have till June 15th, but your taxes are due April 30th. And with everything else, the interest rates have gone up on those. So if you don't pay your personal taxes by April 30th, the rate the government is charging now is 10%. So it is a bit of an ouch. So make sure you're doing your best to get them paid. Again, proposed measures will have significant implications on estate planning. So please, it is a good time to relook at, is your estate plan in place? What are your taxes that might potentially will be payable? What are your taxes now with the new increase to capital gains tax? And if you are trying to fund some of your estate tax using insurance, you need to up your insurance that you have coverage on to make sure your taxes are covered there. Broad powers proposed for CRA. What is that really getting at? The backlog that we just talked about of tax legislation does lead to uncertainty. You know, we're trying to do some planning, and when you don't know what the tax rate will be today on certain transactions, it's tough to plan. And things are getting more complex, more compliance. So if you're looking at a career as an accountant, I will say it is a great career. Please join us. We need more of you. Again, speak to your MNP advisors, your advisor out there, see what these changes will really mean for your business, mean for you. And MNP does have updates, so if you're not part of our mailing list, you can sign up and we will be happy to send you lots of information. I think that's all I have.
I think so.
I think that was a lot.
We warned you.
You warned me. You warned me. Well, my wife does our taxes and I gave her a hug, so I guess that's really good advice.
I was mostly laughing at that comment because I find there's a number of accountants that are introverted and really don't want your hug.
Yeah,
Maybe a pat on the back or a
Yeah,
thing.
you have to be hesitant because there's people that are like, no, I'm good. All right, folks, if you have any questions for Heather or Tracy, jot them in the chat box for us, and if there's anything that comes to mind, and I know it's a lot to digest, and we really appreciate them trying to summarize what is a massive document, and they did it in less than 24 hours, and to me that's just mind-blowing. So to be able to come up with that information. So if there are any questions, again, please just drop them in the chat box, or unmute yourself and let us know you have a question, and we can go from there. Give you a couple of minutes to collect your thoughts. Okay, well, I'll get the ball started. What was the most surprising thing you saw as you briefly scanned through this document? Was there things that you were expecting, or things that maybe you weren't expecting that happened?
You want me to go, Tracy? I think that my biggest surprise, I think that there was a lot of information out there saying that we should expect an increase in taxes. And, there was a lot of speculation of what does that look like? There were articles on, is it an estate tax? Is it an additional tax on death? What have you? I guess I was a little bit caught off guard by the increase in the capital gains rate. We'd been expecting that for quite a while, just to kind of level out what the rates are. As dividend rates have changed and capital gains rates have changed, it was going to level out the playing field there. But those AMT changes that took place last year and the GAR changes leveled out some things. So I wasn't expecting it this time, I guess, to say the least. So that one was probably my biggest surprise with this year.
I'd say mine too, and that they gave us a window now till June 25th before it comes into effect. Quite often an increase in taxes is usually effective that day. All the sin tax is going up, it's that day. This one, they gave us a window, so that was interesting.
Yeah.
How does it compare to past years when it comes to budget announcements? Was it a little more detailed? Was it were there maybe more announcements, or was it deeper, or what? How does it compare to other years?
I would say this year's was like last year's had a lot of really big picture things. Like there was a lot of information with respect to that new general anti-avoidance rule and kind of framework that was laid out. This one seemed to really impact the numbers more, would be my thoughts on that. A few more credits, a few more changes to, obviously they're really incentivizing the building of houses in many different ways. But I think that this one, last year, big picture, this year was kind of more granular and kind of attacking I don't want to say attacking, that's probably the wrong word, in impacting the taxpayer.
I'd say it still is missing a lot of the details though, and I would say the last 2 years they've been like that. Before, we would get 300 pages of draft legislation with the budget. And so you knew exactly how the proposals would work, and gave you a lot, too much information to try and digest all at once. But at least you had it there to start with. Now, some of the, the entrepreneur incentive, we don't really know what that is going to look like. And
Yeah. I think that's a really valid point. It used to be like, I just pulled open my budget document, and you used to have pages of kind of a summary, and then it actually showed you the legislation and all of these things that have been implemented is saying that, more info to come essentially. So gives you kind of the big picture idea of what they're trying to do, but not how it's going to be implemented. So we have no real info there.
Okay, so rely on your accountants, be nice to your accountants, and they'll try and find the information for you as best they
Be
can.
patient, please.
Be patient, especially this time of year. Exactly.
Yes. Yeah.
Well, if there are no questions, thanks for that comment, Jason. Good perspective. Thank you for the overview, and absolutely, we definitely appreciate the overview. With that, we'll thank you, Heather and Tracy, and we thank everyone who joined us today. A few reminders of upcoming events. We have a Mind Bite with Laura LaValle from the Northwestern Alberta Foundation next Tuesday. Ribbon cutting for Grand Prairie KOA Journey, formerly Camp Tamarack RV Park, on Wednesday. A ribbon cutting for Build Grand Prairie on Thursday of next week, as well as our Spring Business Showcase. Booths are sold out, but we're looking for attendees to come and join us for a lot of fun. We're also 4 weeks away from our Peace Region Energy Show. Exhibitor booths and sponsorship opportunities are still available. And we encourage those planning on attending the show to take advantage of our free visitor registration on the website prenergy.ca, or by contacting our office for more information on any of our events. And of course, you can visit grandprairiechamber.com. So with that, we will wish you all a great rest of the week. Thanks again to MNP for this presentation, and let's do it again in a year.
Sounds good. Well, thank you all for attending, and thanks for coordinating it.
Bye-bye, everyone.
Bye-bye.
thanks. Bye.